I've said it. I said it in 2021. I said it at the beginning of this year, and I'm saying it again right now as we kind of end the first quarter. Will be the year of credit union acquisition of banks.
Pat?
Get my curtains
We are recording.
All right, so our topic today is mergers and acquisitions. And Jim's going to talk from the perspective of brand, media, market opportunity. Michael, I'm so excited to hear your thoughts on first helping us define what those two words mean in 2022, but also to really hone in on why a financial institution should be considering either of those two tactics. And I kind of want to start with acquisition. Based on our last conversation, you said that's a hot space to really look into right now. So my first question goes to you, Mike. If I'm a leader at a financial institution looking to grow my footprint in a region, a charter, or field of membership, why should I consider an acquisition strategy?
Yeah. So first, let me say that 2022, Matt, you mentioned relevancy, and this is important to note. I've said it. I said it in 2021. I said it at the beginning of this year, and I'm saying it again right now as we kind of end the first quarter. Will be the year of credit union acquisition of banks. So we, barring an act of God, more of these will occur this year than has ever occurred in the last 10 years. And we've had some pretty busy years, some double-digit years in this regard, but this year is the year. And as far as the strategy goes, if you're a CEO in the C-suite or a management team, or even a board for that matter, and you're thinking strategically about your credit union, the question of why, why would we do this, or why are our peers doing this? I think we can really group that into just a few main segments. So this certainly can be about geography, and the credit union space in part is a geography kind of business when it comes to field of membership. So you can absolutely think about this in terms of geography, and credit unions have looked at geography to determine, is this the best way to enter some new space, or is this the best way to perhaps enhance some existing space? And the answer to both those questions for many is yes. So you can reach that conclusion by looking at the build or buy question. So every credit union can look and see, what does it cost if we buy some dirt, build a building, and fill it up with members? What's that cost? How long does it take? When does it pay back? And can compare that with the strategy of what does it cost if we buy? If we buy an existing institution with these buildings, with customers, and when does that pay back? And I'll tell you that 100%, which is pretty unequivocal, of the time, it's cheaper to buy. If that's what your decision about, it's cheaper to buy and it gets paid back quicker. Now, just to finish the thought process, many credit unions are also doing these transactions or thinking about these transactions for a couple other reasons. One would be assets and liabilities. So depending upon your institution, this could definitely be about liquidity, about deposit gathering, about getting instant deposits on your books. Or in the converse, it could be about loans and assets. It could be about diversifying your lending, getting a new lending product, getting into a new line, or just simply getting more of what you already have. So plenty of credit unions are excellent first mortgage lenders and will absolutely acquire an institution that has an excellent first mortgage business to just bolster what they're doing. And then third, this can absolutely be about talent and capabilities. So today, more than ever, I'm seeing credit unions talking about how do we grow our talent? How do we grow our capabilities in areas we're weak, whether that's commercial areas, treasury management, member business lending, ag lending, or commercial deposit gathering, deposit services, maintaining, those kind of things that perhaps they don't have. They could certainly try to hire for it, play the long game, or they could acquire, and the day after closing, we call LD1, legal day one, they could have that capability and talent literally overnight. So those would be the main drivers, and there's certainly other things to consider, but for these purposes, that's the macro look, or the three main drivers as to why this would make sense.
So as a kind of piggyback off that, Mike, 12 years ago, I was reading your bio on the firm's site. You pioneered a new option for credit unions and oversaw the first purchase of a community bank, if I understand it correctly. That seemed like a big moment, but as we've moved forward, it looks to me like there are more opportunities for credit unions and financial institutions than just community banks. Can you talk a little bit about what other acquisition opportunities exist out there?
Yeah, absolutely, Matt. So, we can think about it like, I call it kind of like bookends per se. On the one side, you certainly have what I call a whole bank acquisition. So you can buy a whole bank, get the whole shooting match. Or in the converse, you could buy bank branches. And when I say bank branches, I don't mean vacant bank real estate. That's not what I'm talking about. I'm talking about a mini bank deal where we're going to get the real estate, we're going to get the deposits, the loans, and the customers that are all in that building or buildings. So it's like a mini bank deal. And then third, I've yet to coin a catchy term for this, but it's kind of the everything else category, literally kind of soup to nuts. Investment businesses, insurance businesses, specialized lenders, mortgage originators. I had a client buy a real estate brokerage, which I think is very innovative and super fantastic. So this particular client, right, has mortgage lending that they do very well. They get you your property and casualty insurance. They also have a title insurance product. And oh, by the way, they're going to buy it and sell it for you. And then add an asterisk to that, they're going to rebate back some of the commission. So it's a massive win for the institution, and it makes being a member extra relevant, right? That's a huge give back. So I think that kind of one of the leaves or the last messages I try to explain to a senior management team or a board when thinking about this is, look, your idea that perhaps you can kind of merge with another credit union and that's it is mistaken. You can acquire anything from a whole bank down to a one-person mortgage lending business or real estate business, and it really runs the gamut. What I didn't just say is this is the best strategy for everybody and everybody should buy everything. What I said is you can essentially buy everything. Now we need to figure out strategically if it makes sense for you or not, or where in that menu you might want to execute. And I'll add one more thing. This is a very simple concept, but one that I think is important. All these businesses today exist. When businesses sell, they're gone, right? So in a way, there is a sense of urgency in that if you want to get in this business of acquiring, no matter what it's going to be, the longer you wait, the fewer targets that are out there for you to acquire. So this isn't a fire drill. My hair is not on fire, but I speak with urgency in that if you want to get in this business, get in sooner rather than later so you have more targets, more opportunities that you can execute on.
Great. That was another great answer. Thank you. So Jim, I'm going to pop over to you for a minute here. Financial institutions that are considering looking at different areas or regions that may be outside of their field of membership, or maybe it's part of their charter, but they haven't been to that territory before. What should they be looking for from a media perspective? How do they test the landscape in a new area?
Well, I think testing the landscape kind of goes into a couple of areas. And the first one, it may not be quite media related, but it's actually more technological capability related. One of the things that can be challenging is the integration of the varying tech systems. And sometimes you'll have an organization where one isn't nearly as tech savvy as the other. And if you have membership that either you're going after from this merger or acquisition standpoint, whoever is the quote winning organization, their systems are probably going to be the ones that carry over. And what you don't want to have happen is a reduction in capability, right? So if you're going to have folks that are a bit further out, you're going to want to make sure that you're going to be able to grow that within that new space. Now, obviously, once the merger or the acquisition is completed, you're getting all that new membership. But obviously, you don't just want to stop there. You want to grow beyond that initial beachhead that you've established. But if you don't have things like completely online member onboarding, that's a big one that we see a lot of, where a credit union or a bank will come to us and they will not have the ability to bring on a new customer or a new member without them ever stepping foot in a branch. And that is an absolutely critical component to growth today. You will find that and we have the data within our existing client set to back this up, that member growth, customer growth, loan deposit, all those will be stymied by having friction in the process. And forcing consumers to go to an actual location to do business is a friction point. It doesn't mean that branches are dead, because they're not. It doesn't mean that you shouldn't have branches. What it means is that there is a ability of self-scheduling that goes with a digital offering. And instead of saying you can only do business during these hours, you now allow someone to do business at a time which is at their choosing. Again, that self-scheduling, that frictionless process. The other component that you have to look at as you're going into a new area is, what does the media landscape look like? Because you are going to need to introduce either this a new brand, or in some cases you have two organizations, one buying the other one, and during that process you might have an entirely new brand created within that then has to be brought to consumers. You might have an old brand going away. You're going to have to work to overtake that old brand and move on from it. And you're going to have some folks that are going to be a little grumpy about that fact, but that's okay. We can't please everyone. So ensuring that new brand is brought out there, and it isn't just, hey, take it from a credit union standpoint, we just purchased this community bank. Well, let's push out there all of the reasons why this is going to be beneficial to the community, to the new employees, to the vendor partners that credit union is now going to be bringing on, and to new membership that ultimately they're going to be looking to grow with. So pushing out that new message of this is the change, and change does make people nervous. You have to be very aggressive in showcasing why this change is not only a neutral situation where, okay, I'm not going to lose any of these things that I loved. Not only are you not going to lose the things that you love, but you're going to gain so much more from this. And then, of course, you can now use that to both protect against any member attrition. And if I recall, maybe Mike can touch on this a little bit. Member attrition is something that is not a huge concern during the acquisition process, but then growing new membership from that acquisition point going forward.
So, when I think about these transactions, right, these acquisition transactions, there, I believe, is a magic kind of moment in time, Jim, where just prior to closing, with respect to the regulations and things, the acquirer can make some communications to its future members, right? And then we close, which is usually on a Friday, and either on Saturday or Monday, we open the doors. And we then are the owner and can communicate however we want to these new customers, new members. I assume that there's some sort of key thing timing-wise that you kind of have to be ready to act to assure that these folks, again, feel good, and then we can grow wallet share, grow product per household. I don't know if you could speak to the importance of that timing and that kind of execution, all focused around this moment in time.
Yeah. The challenging part there is obviously there's only so much you can squeeze into that tight moment in time, right? And the sooner we move from this has now become this to getting rid of what was in the past and moving forward into the future, the faster we do that, the better, because we want to quickly reinforce with folks that this change has happened and then get them past that change moment. The longer we're dual branding, the longer we have competing brand messages, things as simple as color, logo, et cetera, the longer that goes on, the longer we have a challenge in being able to just concisely and consistently driving home any brand messaging, any tone, any product or service messaging, wallet share growth, product per household growth. All of that is going to be slowed if we have kind of two competing brands. So the sooner that we can move on that, the better. And there's two very, very quick ways to start pushing that process fast. And they both wrap around retargeting. Okay. So utilizing the existing memberships, the existing community bank site, what you can do is you can place targeting pixels on that site. That way we know who all the folks are that are going to that site. You can then take that targeting bucket and start pushing messaging day one to those folks, right? So anyone that has gone on to the purchased organization's site, we know who they are, and now we can push the right messaging to the right people at the right time. Secondarily, you can also take all of the address information, the home addresses of all of those folks, load them into an IP-based targeting system, and now deliver messaging, again, directly to the cell phones via mobile advertising, the desktop computers in their homes, the Apple TVs, the Rokus, traditionally known as OTT or over the top. You can deliver messaging there. So sequestering out the folks that need to hear that new message is one thing. And then you have your existing membership, because the existing members are going to say, oh, well, they're growing. I wonder if anything's going to change for me. How am I going to be impacted? So you want to make sure that that messaging is also provided to existing membership to let them know, hey, yes, we're growing. Yes, this is a positive. Here's the positives that are going to come from that. But what you don't want to do is intermix that messaging, because obviously your existing members don't need to have this brand change reinforcement presented to them. You're going to have some bleed through, but the more you can build out your targeting buckets as you're leading up to that legal day one, the better off you're going to be. And I would suggest 90 days before that. But I'm not sure, honestly, from a legal standpoint, when these organizations can start sharing information. Is 90 days too soon? Could we go later than that? Well, we need to go tighter than that. But the sooner that targeting information, the pixels can be placed for targeting from the different platforms on their digital assets, the sooner we can start building out all of these different targeting buckets and models.
Yeah, and I'll just add that it's interesting, just so to provide some context, when we engage in one of these acquisitions, everything is analyzed and modeled as if when we acquire it, we're not going to touch it and it's just going to continue existing. It's a very conservative way of modeling. So when we look at what our spend is and what our payback is, it's almost considered like a bolt-on. We buy the bank, we bolt it on, and we just leave it alone. Such that if we can get ourselves ready and have success in what you just discussed with product per household gain, wallet share gain, those type of things, it's truly icing on the cake. And it will take a payback period that we loved and we're comfortable with, and it will slash it and make this the best thing we've ever done. So there's a real pickup here, or a real gain here, that is powerful. And I've seen credit unions do it. We've got some mutual clients. I've seen it be successful, such that the acquisition goes from being great to super duper great. That's a technical legal term for their members and for their financials. So this is a key moment. This is a key thing for folks to keep in mind, and a chance for a real win in a deal.
So actually, Matt, is one of the things that I see a lot of, and it seems like right now, and maybe this is wrong, but there's a lot of open CEO positions out there. It seems every time I open up, Credit Union Times, there's 3 or 4 pages of ads for open positions in the C-level, and a lot of them are CEOs. For credit unions that are looking to acquire, right? From an acquisition standpoint, is that an area where they can look and say, oh, this is a credit union that maybe is having a hard time finding a CEO? Or from the standpoint of a credit union that has a CEO that's retiring and, unfortunately, they don't have a very good plan to go forward, is there an opportunity for them to go, hey, we might be a good merger? And I know we're jumping from the purchase of community bank standpoint to the merger standpoint, but when you brought that up, it popped in my head that kind of issue that I'm seeing with a lot of CEO open positions right now.
Yeah. So look, I think that it is exactly true. So if someone asked me, what would drive, or what's a key driver to credit union mergers, or for that matter, what's a key driver for a bank to sell and be acquired by a credit union, I would say to you, one of the consistent themes that has cropped up in the last 2 to 3 years is succession planning, right? A talent gap in the C-suite and the management suites or at the board levels. So absolutely, more often than not, I believe in a credit union to credit union concept, succession planning or CEO retirements or CEO needs are driving these. And then second, absolutely, one of the biggest reasons a small bank or community bank would sell or seek a buy partner would be because their management team is aging and they don't have ready replacements, or their board is aging and they don't have ready replacements. That's real. It's absolutely accurate, and it's not going to get better. I don't see some, massive influx here that's going to change things, and everybody's going to want to become a community bank president when they get older, or everybody's going to want to become a credit union CEO when they get older. So this is here, and it's staying, and it will continue to drive numbers in both sides, in both spaces, without question.
So the funny thing is that both of you have answered a few of the questions I had as follow-ups in the answers to the questions that, yeah. But, Mike, back to you. When, or I guess, is a merger ever beneficial over an acquisition? When does it make sense to consider a merger? And then if you could just clarify something for Jim and I, give it to us straight. Is there ever such a thing as a merger of equals? Or, is one side always have the upper hand?
Yeah, so look, if a credit union comes to me and says, we want to grow non-organically, right? And just for perspective, their organic growth is kind of their current machine, introducing new products, new loans, new deposits. We want to grow non-organically. I would say to them, a complete non-organic plan, or one that is most likely to be successful, is going to involve 4 things. 1, absolutely credit union to credit union mergers or combinations should be on that plan. 2, bank acquisitions. 3, bank branch acquisitions. 4, all that other stuff, depending on your strategy. That's a complete plan. They're absolutely different. They're all unique. Perhaps all 4 are not right for everybody. But if you're serious about your non-organic growth, I think you have to be open to all opportunities. And they're completely different. A credit union to credit union combination is one that does not involve the exchange of consideration, right? It's not a money thing. Money doesn't change hands. It's not induced by money. It's not a negotiation over what are you going to pay me, what aren't you going to pay me. Where on the acquisition side, it's always about money. We're selling, you're buying. What are you paying? What are we accepting? It's completely opposite. And there are parallels here. This is not unique to our space. This is true in the healthcare space with nonprofit hospitals and for-profit hospitals. Same thing. It's the same exact dynamic. Same in the There aren't many of these around anymore, but there were a lot of farm co-ops at a time throughout our country. There were cooperatives that were nonprofit, and then there were other farm services that were for-profit. So this is identical across industry boards, but it's totally different in how one versus the other works. Now, again, I think optimally both are where you need to be, because they both happen on different timelines and for slightly different reasons and in slightly different ways. And many of my most successful clients across the country, my most dynamic clients, are in both and are doing both. And in fact, it's very common to do them at the same time, because they do involve certainly similar things, but very different things when it comes to consideration and regulatory matters. So you can do them both at the same time, by all means. Oh, and then let me touch on merger of equals. So MOE and MOE, that's what you hear in the space, or merger of equals, certainly is a thing. Now, I will tell you, in my opinion, that doesn't mean you look at the assets and you look at the assets and they have to be almost identical to be an MOE. I think MOEs are better understood as equals, and not just asset size, but in sophistication and presence. As an example, I think a 2 billion and a 5 billion credit union could merge, and it's essentially an MOE, in my opinion, depending upon how dynamic they are, what businesses they're in, and how they work. But an MOE really is a joint collaboration where you're going to see the end result truly be an almost equal combination of management, of boards, of products, of locations. And right there to me, the I call them the great white whale. We could call them a unicorn. We could call them any other kind of culturally relevant thing that's unique and rare. The black swan, right? I'll keep going if I don't stop. They happen once or twice or 3 times a year, and every time they do, everybody goes, "Whoa, that's really cool. That's beautiful. That's strategic. That makes sense." And then they never happen more often. It's still limited because it's such a dynamic thing that everybody marvels at and really thinks, boy, maybe we could do that. I love them. I wish they happened 20 times a year, right?
Great. And this question is actually for both of you. And Jim, you can probably lead this off or you can throw it back to Mike. But what makes an acquisition go smoothly? And inversely, how can you really botch this up if you're the person, if you're the brand that's acquiring another?
Yeah, I'll speak from the consumer point of view. Communication. That's what this all comes down to. The more that you can explain what is happening, why it's happening, why it matters, and how it's going to benefit, that's what we need to hit. And that goes across the board with your current members, the new members that are coming in, the current employees, new employees, because everyone's going to want to know, oh, what's going to happen here? There's 2 VPs of marketing. What happens? There's 2 IT teams. There's 2 regional branch managers. So those communications are going to be very, very important from an internal standpoint. And remember, internal matters to external, because all those folks that are a part of this merger, they're going to talk about the merger process, whether you like it or not, after it happens, what it was like, how it made them feel. Did they feel valued? Did they feel undervalued? Do they feel like they were fighting for their job, or was there a more, open and egalitarian process to that? And that's going to inform consumer sentiment about this new entity that, for good or ill, is going to own the outward appearance of the internal communications. And then, of course, there's your external communication. And that is the exact same situation where you're going to have some folks that don't know what's going on. You're going to have folks that didn't even know that it happened the day that it happens. They're going to be surprised when they finally learn about this. And you could have sent them letters and emails and mobile alerts. You could have put up billboards about this and run radio spots and done you could have done everything possible. And you're still going to have folks that, for example, go on social media and light up the merger. The thing to remember there is empathy. Have a team ready to deal with those situations quickly. And I'm talking within 10 or 15 minutes of that, of a possible negative experience floating out there on, be it, Instagram, Facebook, TikTok, LinkedIn, wherever it might be. You need to have, a social media team in place for at least the first couple of weeks, that their response levels are going to be far more elevated than your traditional response times, because the longer this stuff sits out there, the longer the narrative is, this has changed. It's now different. I don't like it. And again, it isn't, the positive takes care of itself, right? We don't have to be terribly controlling of all the positive news and positive information, because that's all great. That's all great information. But keeping your ear to the grindstone on these social platforms and addressing them, not hiding from them, having as open as a dialogue as you can with folks on that platform. Again, as long as they're being civil, people start being uncivil, that's an entirely different equation. Ban them, move along. They're just looking to, spam the thread and be trolls. But if you want to have that open dialogue with folks, that's a great place to have it. So, having that quick response team is in place, and just remembering those two key words, communication and empathy.
Yeah, and it's interesting because we're dealing with entities that are regulated, right? There is a time lapse here such that the way these transactions work, we're going to execute a binding agreement. And then we're going to have time elapse before we can close, or before we close during that regulatory review period. So the way I explain it to the credit unions is that there will come a time where we'll sign our binding agreement and then we go on two divergent roads. I personally am going to handle the regulatory process, its review, its approval, the actual closing, the logistical closing, all the legal documents, because credit union has job one. Right. And they're going to have, depending on what we're buying, it could be as short as 30 days if it's a unique business, or as long as 6 to 8 months, depending upon the whole bank scenario, to get ready for LD1. Remember, legal day one. So they need to be essentially entirely operational and focused. And Jim, I'm glad you said what you said. There are multiple constituencies here, right? It's current employees, it's the new employees joining. That's kind of one constituency. There's the community, whether it's the community you're in and the community you're going to. And then, of course, there's the customers and the members, right? There's varying constituencies that all have to be considered operationally, such that from the day we sign and it's real till the day we close, ranging again 30 days to 8 months or so, depending, we are ready when we unlock the doors on LD1 to deal with all three of those various groups and segments and things of that nature. So there's time, but in the end, there's not much time. So starting the day after we sign, it's instant. It's all about integration, operations, messaging, and really getting geared up so that we're ready for day one, for opening day.
Certainly enclaves of growth in the country when it comes to the financial brand space. What areas are you seeing that are really picking up and gaining a head of steam?
Yeah, so I will start by making an unequivocal statement that I think is very important. This being kind of credit union to credit union mergers or acquisitions, credit unions buying things, is truly relevant everywhere. I'm sincere, it's accurate, okay? So don't lose sight of that fact when I kind of break this down a little bit more. So with that in our head, and that as a background, understand that markets where there are more small banks are going to be obviously more relevant than markets where there are a few small banks, for acquisitions. You're just going to see more happen, whether it's in the upper Midwest, where states like Minnesota, Illinois, Wisconsin have hundreds and hundreds and hundreds of small banks, or in the Southeast, Florida, Georgia, Alabama, again, hundreds and hundreds and hundreds of small banks. Texas, untapped territory, hundreds of small banks, right? Certainly those are going to be hotspots. And then in the credit union space too, you can look at this kind of state by state and see there are some states with hundreds of credit unions and there are some states with 10. So numerically, this will obviously happen more often where there are more, right? No question about it, but it's relevant everywhere. Let me make a point here though. We could talk forever. We can slice and dice this a million ways, but there's one thing that I do want to highlight that I think is somewhat unique or something for folks to think about. One space I think that credit unions can specifically capitalize on or have a better chance to capitalize on is the rural space. So if you look across our country, state by state, I don't care where you are, there are perhaps less interest in rural areas just in general when it comes to, as an example, banks trying to bank those spaces or to get into those markets. So credit unions, I think, have a unique opportunity and ability, by the way, to capitalize on membership in these rural areas and serving these rural areas very well. So some of the most successful transactions I have seen have been credit unions acquiring some rural banks. And they have been able to capitalize and to assist those customers when they become members and offer more products. And believe it or not, get gains, membership gains in areas where people think it's not worth banking, right? There aren't enough customers. Well, they're there. People are everywhere. So I've really been interested in this rural focus, especially with technology. I'll leave that to you to explain, but these people in areas need not be forgotten. And can be served and served successfully. Jim, I don't know if you have a thought there.
Well, one of the things that popped into my mind was, the idea of these underserved markets, and can a credit union use a rural bank acquisition as a part of their underserved market strategy?
Yeah, you bet, right? That's kind of, absolutely, and it's happened time and time again. It will keep happening. I think it's one of the best ways to execute on that strategy. And let me ask you, right? There's a way, right? There's a way to market to these areas and be successful in these areas with membership and product gain. Yes.
Oh, absolutely. I mean, you have these areas that even though they're rural, they're still going to have access to heavy digitization. They might not have the fastest wired internet speeds, but they're most likely going to have relatively decent mobile speeds, right? So you're going to be able to hit them across the spectrum in a far more cost-efficient way than utilizing, say, something like traditional radio or traditional television. And the reason why I say that is those things have high waste factors, right? And that's one of the things that we'll always focus on when we're looking at certain areas of media, either from a new member acquisition or a new merger setup. When you look at a given media space, there's only a certain group of folks that are likely to become members or even can become members. So what does that look like? If you have a radio tower that's spreading out over, say, a 50-mile radius, make it real simple, 50-mile radius, that's as far as it goes. So, and within that, let's just say that there's 1,000 people that hear that signal, again, just for ease of math. Now, you might look at it and go, oh, well, we're going to pay $100 to reach those 1,000 people. Well, no, you're really not. Because what if only 300 of them are the ones you actually want and can actually utilize your services? Well, your spot cost just increased by 300%. So what looked like a great deal at $100 is now an incredibly expensive deal. And that's one of the great downfalls of your traditional media model, especially when you move outside of densely populated areas, the media waste that you start seeing goes up dramatically. And media waste exists on every format, right? There's no such thing as media without waste. It's about limiting your waste. The issue with a lot of your more broadcast, untargeted techniques is that they present the opportunity to appear to be cost effective, but once you actually get down into the numbers, you start realizing that your actual acquisition costs, your targeting costs, your messaging costs go through the roof. In almost any situation that we've come across, in fact, I don't think I can even point to one where the media wastage in take traditional radio specifically has not been less than 30%. So you're talking about considerable increases in costs when compared to far more targeted and effective media types. Now, that doesn't mean that traditional media doesn't have a place. It does. It just comes down to a similar concept that you talked about, those 4 areas of growth, right? And let's see if I can name them all. You have the merger of the credit union. You have the credit union buying a bank, it's a community bank. You have the credit union buying a branch, and you got everything else. They can do all of those. It doesn't mean they should do all of them. And it probably means that 1 or 2 of them is going to be their sweet spot. Media works the same way. You have so many options out there, from traditional media to social to OTT to geographic targeting to IP addressable targeting to behavioral to intent targeting. I mean, the list goes on and on and on. You can't do all of it. And that's one of the tripping points that we see more often than not, is that too many financial institutions try to take too few dollars and spread them across far too many opportunities, thus gaining nowhere.
What does the future look like for the financial industry?
Yeah, so look, I think that some unintended consequences of the regulations, right, of the highly regulated space and the cost to be in that space, are that there is a baseline size or scale that's essentially required, right? So, politics aside, and not blaming anybody or anything, I think there's a fact there that's important. And I think that's relevant in the financial institution space and the hospital space. Again, I think that's a kissing cousin of ours. Name the industry that has regulations, that's necessary. So that in and of itself will cause the industry to have to be bigger or to scale. So we will continue to see scale occurring. Smaller players leaving in one form or another, and players that are staying, growing. And I think that doesn't change. Now, one thing that has not occurred recently that perhaps will occur more is this whole Denovo idea. So Denovo banks or Denovo credit unions are those that are chartered new or started new. And that market kind of ebbs and flows. And if you look back over the last, I guess 10 years now, 11 years, 12 years since the Great Recession, that market died. The Great Recession is the place where that idea went to never live again, it seems. The regulators tightened that up, of course, right? Investors were like, I'm not doing that. No, there's life. There's a heartbeat there. If you look back, there's been some de novo credit unions and newly chartered credit unions, de novo credit unions and banks recently started. 1, 2, 3, 4, 5, very, very small numbers. But you're hearing about it more. So far this year, I've picked up the trade press and you're hearing about de novo banks again. My phone has been ringing a little bit about people wanting to start a credit union again. So perhaps that's going to help balance out this scale thing we're talking about. It will definitely not offset it.
Yeah.
No way. But will it be a hedge to that? Sure. And perhaps it becomes more relevant if we can avoid another huge recession or downturn and give that industry or that piece of the industry a chance to breathe.
Are these Denovo entities, are they seg based, Mike? Are they starting up around a specific cause?
So in the credit union world, right, to be fair, I think you can de novo any type of charter, literally federal, state, community, multiple seg, you name it. Now, if I think recently what I've seen in the de novo credit union space, certainly there are some natural fits, whether it's to start one to serve a tribe, right? A certain Native American tribe, wonderful fit for de novo credit union. Or perhaps a certain underserved community or segment geographically. This is an area that is a financial institution wasteland. There aren't any. So a community can come together and put in a de novo credit union to serve that geography or that area of a state, county, or city. That's kind of the low-hanging fruit. Or I have definitely seen professionally, right? So perhaps a group of doctors or a group of dentists would come together and think about chartering a bank, a new bank, or a new credit union to serve that profession. I think that's real. I think that makes sense. I think there's a future in that.
Yeah, and
Jim, I kind of want to tee it up for you because I think Mike hit on a great point, not just around the de novo stuff, but regulation leading to scale leading to innovation, perhaps. Where do you see the financial world kind of going from a credit union financial brand perspective in the coming years?
Well, I think when you look at the scale issue, you also start seeing how maybe the overall industry is moving away from the some of the original intent, right? You look at multiple common bond, you look at seg, but I would actually suggest that the opposite is true from an opportunity standpoint. These mergers, the larger institutions, this allows the true common bond to become the brand. That is the new common bond. So instead of looking at the brand as something that is just a name, something that are just some logos and colors, and it harkens back to 50 years ago, not saying you should throw away history, but looking at your membership, who you serve, who is the right fit, and letting the true culture of the credit union float to the top, become the brand, and connect with the people in the community that you want to connect with. That is your common bond. That's going to create the type of community, no matter if you're a $500 million credit union that just merged, or you're a $2 and a $5 billion credit union that just merged. Both of those have the opportunity to build culture, to build community, and build that common bond through brand.
Guys, this has been great. I guess final question is, where can people learn more or find you guys if they have questions about this conversation? Mike, I'll start with you.
Yeah, Matt. So look, I obviously my law firm has a website, www.honigman.com. But I'm pretty active on LinkedIn, and whenever I speak or meet somebody new, I encourage them to seek me out on LinkedIn. It's where I really prefer to do a lot of communicating, whether it's kind of a breaking transaction, hey, look, this is hot, this is new, or it's some kind of content that we're pushing out that's relevant to a recent regulatory change or a new opportunity. I really lever LinkedIn as the preferred tool to learn more about me and for me to push things out to you and learn more about you. And then certainly I'm always available via email too, which is obviously all over LinkedIn and on my website.
Yep. And, I'd echo Mike's sentiment there. LinkedIn's a great place to catch me, whether you want some tips on coffee cake or you are looking for some nice haikus every Monday. You can also catch us at tune2jxm.com. And you can also reach me at jim@tune2jxm.com.